good thing for jobs. When is the last time we stayed negative besides 1 or 2 spikes? Well, 2020. Go all the way back here. When did we go negative before that? We have to go all the way back. When we're going negative, positive, negative, negative, positive, negative, that was going into the 2008, 2009 recession. That's it. There's no other examples of going back and forth, back and forth. Gotta get out of there. Everything was positive until you saw the big 2020 pandemic lockdowns. But we don't have negative, positive, negative, negative, where you have multiple months, multiple weeks, multiple months going negative. So ADP, if it's right, and it's preliminary, we should expect bad jobs data. In fact, we do have bad jobs data. If we go back and look at the Challenger report, October Challenger report, when we were not getting the numbers, and I brought this up back then, we showed cuts, lots and lots of cuts, 153,000 job cuts in October. And they say, okay, fine, but what about November? Maybe that was just October. Nope, November, they're writing it in at 71,000. So we are seeing more and more job losses in the state. And this is the reason why I think that the Federal Reserve is going to cut rates this time and talk big about labor. They can take a significant shot at the government. I think they're in a political fight right now. If they want to maintain their independence, they're going to take a swipe at them. And I think that's going to put a lot of pressure on the market and a lot of uncertainty. Let's see. Good afternoon, Muffin. Yeah, and I think that right now we're going to probably see JPOW is going to channel his inner CM Punk and deliver hype bomb promo sitting behind that lectern. Can any of it be trusted? Well, the data, that's my point, is even if the data was on time, could it be trusted? It's so far behind. What's the point anyway? And as Ron says, and like I was saying before, they know what the real data is. They have their ways of doing it. Yes, they get the government reports, but they know the jobs are in a bad situation. Challenger is absolutely showing that we are in a collapse and a crash at this moment. So as we're looking at this, and we're looking for this pullback in the changeover, we're seeing a lot of negative data as far as labor. So some of the other things we can look at, we can get into the inflation data. I'm going to go into inflation using gold and copper here in just a minute. We can look at the data overall. But one of the things we want to do is we want to look at delinquency rates and, well, pretty much in everything that we can look. We look at the delinquency rates and credit cards. We can look at the delinquency rates and mortgages. Now, mortgages have been flat for a while. We had a blip up in 2020, and then we dropped down, and we're just kind of going it very slowly climbing. The delinquency on mortgages, we're not seeing this crash yet, meaning spike up and crash the market, but we're slowly moving higher. 7.1, 7 to 7.1, 7.3, 7.4, 7.7, 7.8, 7.8, 7.8. So we've been slowly climbing and we're flattening out. That is a very low delinquency rate. We're going to watch for this. If it gets above that 2% level, really 2.4 is when we've spiked here and right through here. That 2.25, we'll call it 2.25, 2.25 level and higher usually is an indication of going into recession. You can see every single time that it went above that 2.5 line, we were in a recession. Now we climbed up to 2.4. I talked about this the other day in 1996. 1996, we don't talk about there was a recession in mid-90s that we don't seem to like to mark as far as the Federal Reserve goes. They didn't want to qualify it as a recession. But anytime this turns up, anytime this turns up, anytime this turns up above that 2.2, 2.25 number, not even 2.5, we go into a recession. 2.5% of the mortgages in delinquency is a big number. We're talking about millions of homes. 2.5% is a lot of people delinquent, and that's going to put the pressure on the markets. Well, the other one I'm watching for is the credit card rate. According to the Fed, delinquency in the credit cards, we were spiking super fast. Now, we do know that the banks offered resets. They offered pay holidays. When they give you a break, if you go into your bank, I've actually pulled up my banks and we'll say, skip a payment. If you choose to skip a payment and you're communicating with the bank and skip a payment, that resets your delinquency. And so when we see this spike through here, we went from 1.5, climbed all the way above 3 to 3.22, and we're fading back down. But I think we probably saw a reset of the people that were defaulting. If we get back above 3% again, if we see it turn back above 3%, this for me is going to be a major warning. And if I'm looking at this, let's get to the charts, and I'm going to show you what I look for in the charts for inflation and in the charts for delinquencies. Okay, and it's the reason why I can't buy Rocket. And I'll show you what we're looking for. All right. Yeah, we talked about the short in the S&P, and I think we're going to get a rally off of in the short term, for sure, off of the hope expectations of these lower rates. But I do need to show you a yield curve too today, just to make sure you understand short-term rates do not mean long-term savings of money and lower cost of borrowing to the consumer. It means the banks can make money. That's about as far as I'll go with you. It means the banks can make money. Let's see, is this my chart? Nope, that's my rotation chart. Sorry. I want my. Where is my chart? Here, we'll do this one. We'll go back over here. And I'm just gonna go to this chart, mid chart. I'm gonna put in gold, copper, and Visa. All right. Are we hedging out inflation? Just look at this chart for me. Tell me where we're at for the month of December, for the year. Where are we at? We've had a lot of inflation pressure. We've gone from 3,400 all the way up to 4,400. So we've seen a 33% increase. Why would we hedge out inflation 33%? Oh, by the way, we're doing that in the time frame from August to October. So the fact we pulled back and stabilized here, to me, this is inflation. This is inflation. We don't expect more inflation. We just expect us to be in the inflation from here to here. So we've hedged out the inflation. This is how I'm reading this. We've hedged out the inflation. We said this is what we need to price in for inflation. And then we're holding. We see that this big reversal brought us right back to here. It hit there again, hit there again, hit there again. And so I think we're at a balance point. I think we've priced in the inflation and we're holding here. But the fact that we're holding inflation here at these higher rates does not mean things are getting cheaper. It just means that we've hedged out the inflation. And if we're sitting up at this top as a percentage growth, do you think, even where we're at today, 25% inflation in 2 quarters is reasonable? That's what we've hedged out inflation-wise. 25% is what gold increased in value. If gold is supposed to be this eternal, never, perfect little hedge for inflation, we have priced in 25% inflation in a quarter. That's massive. If we take a look at copper during that same time from August until now, taking a look at copper, and this is all what we're talking about from that same time frame, I'll even ignore this. Because if we're seeing this, I mean, arguably, I would say that we have a slowdown of negative 10% demand-wise. If you went off the highs and go back to July, I'm going to say ignore that. And let's just go from August, the same lows that we just looked at for gold, and say, how did we do? That means growth since those lows, since the reset of copper, since the copper got its teeth kicked in, we've seen copper go up and demand go up 16%, while the inflation went up 25%. We have a stagflation rate of 9% difference between growth and inflation. 9% stagflation. That's what I'm looking at. Growth grew 16%, gold 25% in 1 quarter. To me, that is a precarious situation to be in. We priced in a ton of extra costs. And the cost of that inflation in the gold, you're seeing it across the board. The only reason why we're not seeing higher inflation prices is because of crude. And crude prices, and again, we'll ignore this. We'll just go to the same time frame and say August 26th is what we're, or 25th, 26th is what we're looking at. So close of August 26th, oil prices down as of today, 7%. So that's helpful. That's kept inflation in check as oil prices fallen back down to these lows. But overall, gold is at a balance point. We're seeing stagflation pressures, rising inflation at a significant 50% higher than we're seeing growth. And that's a problem. If growth is at one level and we're seeing inflation at least 50% higher, that is significant. Now, I said the consumer is the one that's going to get beat up. If we take a look at, say, the 10-year Treasury yield, and we see that we put in a new multi-month high today. If we were betting on rate cuts helping the consumer, you would not expect to see inflation, or not inflation, interest rates hit the highest level they've been at since September. Interest rates are the highest level they've been at since September. We've made higher highs, higher lows. We've turned, yes, today's a down day because we're pricing in that inflation or interest rate cut potentially, but we still hit the highest level since September, the first week of September. So we're now 3 months into this and we're hitting at new highs in the interest rate. And this is where we borrow. We borrow the 7-year, we borrow the 10-year for any long term. The only one we borrow short term against is credit cards. And so as we look at the 10-year Treasury, these yields are telling us that we are not saving money on mortgages. We're not saving money on cars. As we go in there and take a look at the short term, if we see the consumer strapped, I expect Visa to continue to go down. Sure, let's take a look at eBay. We can look at eBay and Pinterest and or not Pinterest, Etsy. Because if we're really going to be stretched, we're going to start selling stuff on eBay, right, Daniel? So where are we at? Up, down, up, down, up, down. I still think Visa is showing us. This is the canary in the coal mine. If we look at the past year, or even 3 years, when we saw this come down to these lows, this is a very significant support level right here at 336. We closed down there on the weekly. We retested it as the high. What just happened? We retested it as the high, pulled back. And for me, that's a rejection of old resistance now, or support as new resistance. We're getting a sell signal and Visa has downside. And this is a representation of the consumer. Remember, Visa doesn't make its money off of interest rates. They make their money off of transactions and fees. So this is putting the pressure on. And for me, Visa is the canary in the coal mine. As you know, I also like ITB. ITB Home Builders is one that I like to fade. And you say, look, we're up 1.3%. Yeah, it's a technical bounce. And I would be looking to sell again near 101.55. Let's take a look at eBay for you. Well, from a technical perspective, I say it's a short. It's bearish. We went right back to the monkey bar. We have a bearish close. eBay, I'd expect this to come down to 79.28. I don't know if it's a trade because it's pretty strong support through here. Support, 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 support. So yeah, I don't know. I don't know if I'd take the trade short, but I wouldn't be a buyer. So I'd check the options and see if we could sell calls up at the 85.70 and set up the trade for the next move down. So as we go into this, I already showed you the delinquency reports, the rates. I was going to show you. Let's see, one other chart. Yeah, we can look at, here, let's do Etsy while I'm trying to remember the other one I was going to show you. Etsy, haven't bounced off the lows. Looks a lot like eBay. Wants another test of 50-50. That's almost 10% on the way down though. That's a major pullback, if you ask me. All right. Let's do this. Yeah, anytime I can sell Meta, I'm interested. Anytime I can sell Goldman or Wells Fargo, I'm in. All right, let's take a look at Meta for you. They announced they're getting rid of basically their Meta universe and all the stuff, and so they spike up. Yay, save us money. Oh wait, not a good thing. All the way back down. We're right at fair price. I would have said yesterday as your short back to 645. I wouldn't take any bounce until it got down to 620, but right now it is bearish in my reading of the distributions. Now, if we were to look at the market today, knowing that it's a Fed day, knowing we have a lot of pressure, who benefits from rate cuts? Theoretically, who is going to benefit from us pricing in a rate cut, even if it doesn't work out? Now, I said Visa is a company that will benefit from transactions, and therefore no transactions means no money. If we're cutting rates, even if they don't lend, Don and I talked about this 2 days ago, even if they're not lending, the lenders and the banks can get paid on their reserves. So companies like HSBC should have a bullish day going into today. And we have this massive gap up. Now, I don't think that I would have been able to trade that because it went from here to here and the gap didn't already hit my target. But if it breaks through this high, price pattern wise, I would expect it to do about another 5% above the highs. Now we're betting on this because they don't have to lend to make money. And if they can borrow at lower and lower rates and they get paid better for the reserves from the Federal Reserve, then they're justified in making money without even taking a risk. That's a safe trade, assuming that's what they continue to do. But who else would benefit? Well, like I said before, Visa does not benefit from interest rates or charging interest. Who does? How about American Express? If we're getting lower rates to them, it does not mean they're going to go and say, okay, everybody, you get another quarter point lower on your interest rates. They will leave the interest rates at the levels they are, continue to charge the higher levels. And the lower those rates cuts go, theoretically, the more they're going to make on the balances until the defaults kick up. So I would watch the companies that do lend money in the short term, like on credit cards, and then Capital One Financial we know has been climbing here to do it recently as well. And this looks very much like HSBC, and HSBC does do a lot of credit cards too. And so we're seeing these higher highs, higher lows. These will break free because they're going to make more money until you see the uptick in those credit cards. Watch for the credit card default from the Fed to go above 3%. And then wherever you're at in AXP and HSBC and any of the lenders, take profit, step to the sidelines, possibly even go short when those defaults kick in, because they're not going to be pricing in defaults while they're making more and more and more money. So this ascending triangle or this cup and handle, it's kind of a backwards cup and handle. This, like I said, I'd probably call it an ascending triangle. This move goes from 337 to 374. We're talking about 35 points, another 10% on American Express if it clears the high. And today is the day that it's putting that pressure on. And I'm looking for this to go up to the next level. Now, we had, who was it that's talking about Starbucks? And I'm out of my trade. Who likes overburnt coffee? So the breakout here, move down. This is again showing you the consumer is stretched, pushing lower and lower and lower. Now, I do think Starbucks is also losing shares or losing market share. We're seeing this push lower. I would expect it to drop down through here. It's not that people are not buying coffee. They're just not buying it from you, Starbucks. So if you look at Dutch Bros, you're going to see a lovely higher high, higher low situation going on here. If it can get back above 61.18, I do think you could be turning this into a long-term trend, and the bounces are seeing about a 15% rally. So you could see this go to 65, possibly all the way up 69 to 70 this month. So that's something else. And then what we talked about with Brandon the other day is like Rost. Sorry, there we go. I like all the discount stores. Walmart. Oh no, it was with Don that we were talking about. No, it was Brandon. One of the two I was talking to. Ross Stores, Dollar General. TJ Maxx or TJX, Walmart, all the discount places. We're going to see more money moving to them, and it's just a swap. We're going to stop spending money at Harris Teeter or Fred Meyer, and we're going to go spend it at Walmart. We're not going to go to Dillard's. We're going to go to Ross. We're not going to, and TJX, Marshalls, all the other discount clothing stores. And that's including this holiday season. So as we push up through these highs, we're seeing that priced in. Ross, I think, has an upside target of nearly 190. If you take TJX and Dollar Tree or Dollar General, higher highs, higher lows. This broke through. That's a price pattern I was watching. So I'm looking for 158 on TJX. Yeah, small cap, small companies, they're going to get a lot of money from there too. And we're going to see the continuation push higher in these types of stocks, in the discounts, in the Dollar Generals, in the Family Dollar. The fact is that we're going to see that recovery in the growth. And you can see we went, now we're paused right here, so still could be a good opportunity to buy. But Dollar General went from 95 to 135. That is nearly 45% increase, because we know that when the consumer is stretched and they can't afford other things, yeah, they're going to go shopping for food products, for cleaning products, for gift ideas at Dollar General. This is going to push higher and higher and higher and higher. Now, as far as moving money into investments, like I said, I'm telling you who's going to make more revenue, who we're going to bet on in this economy, in this situation. As we're looking at this, we're looking for those moves there. That would be Dollar General, Ross, TJX, and things like that. But if you're talking about investments, then we would be looking, correct, at high dividend stocks with good safety, good stability in their markets. And so if we can see stocks that have good debt structure, if we can see that they offer a good dividend, if we see that they are in a situation where they, I already said debt structure, good dividend, and they're also giving us a technical chart, those are ones that we can take a look at for returns and benefits from that way as well. So you talk about UPS. UPS has a really good dividend. Someone asked about UPS, so we'll look at UPS. It has a really good dividend. It's about 7%. And as we're looking at this, we've made higher highs, higher lows after the gap around earnings. I'd say this entire thing is one big trend. And as we're breaking out today, it says we should be going up to certainly 99, which it already hit. I'd be looking up to 100.62. It's about 2% there. But in the big picture, we have this trend that's going on. And we could continue this trend all the way up to 106, 108. So if we own this, not only are we getting paid about a 7% dividend yield, we could sell calls against it. We can get the appreciation of the stock. And over the next month, 2 months, we should see us get up to about 101 to 104. If we go to 104, you get about a 5% appreciation in a month to 2 months of the underlying. Plus you get your percentage prorated for the quarter instead of the year on your dividend. So you make another 2% roughly. So you could have a 7% return, and that doesn't even count the fact that you sell covered calls against it for another 1 to 2% as well. So this could be set up for a longer term trade that's going to pay you out 7, 8% in a matter of the next month or 2 months in a pretty conservative fashion. So I do think, yes, the stocks that are in the dividend space that have high dividends, but that also have good debt structure, because you want to know that they have cash flow and good debt structure to be able to handle whatever's being thrown at them and still pay their dividend. At least that's how I approach it. If they can handle that and still pay their dividend, that's what we want to look for. All right. Now, the healthcare sector you've talked about earlier as well. I've talked about healthcare sector as a place that offers good dividends. We pulled back pretty aggressively. This is a widening pattern. I talked about this the other day too. Widening patterns have a tendency to return to halfway. So even though it could go into a downtrend, if we're getting a bounce here, we're getting inside day harami, and we trade above today's high tomorrow, this could be an opportunity to buy and trade it back up to 155. That's about 3.5%. But individual stocks inside might give you a better trade opportunity setup, where we could look at something like, let's look at Bristol Myers. Bristol Myers pulled back, didn't pull back as far as I'd like, but they pay a 5.5% dividend. So a 5.5% dividend, is it worth it? Possibly. 5.5% dividend on the stock. And if we're looking at this in uptrend, we've gone all the way from here, the lows of 42 and all the way up to 52. That's a 25%, well, 22% increase. If we continue this trend, we're doing about 10 to 11% per month. Add to that your dividend yield of about 5%. Are we concerned about this previous high? No, we're above it. We broke out through the 6-month high. We returned and bounced off of it, which was the high from back here. I think it's a pretty conservative entry as far as buying near a support level where we can control our risk. So if we look at the stop loss, we can say, okay, let's just put our stop down below these lower shadows, put it down here at 50. I might be able to get into this trade and risk $1 on a $50 stock. And if it stays there and goes higher, great. Let's take a look at the options like I like to do. Normally I do this on a Thursday or Friday for the long term, but let's scroll over here, scroll down. Current IV rank is super cheap. It might be just worth buying the call. If we're buying the bounce, it might be worth buying the stock so we can participate in that dividend. That dividend likes it about 5%, 4.85. And if we look at the 30 days, yeah, we could sell. You could sell this. Let's take a look when that dividend payment is. Dividend payment was October, so theoretically it's going to be January. January, again, it's not declared yet, but if it's after the January 9th, we might want to get assigned. And if we sold the 51, they're going to pay us 3.25%. They're going to give us $1.60 below the current price, which means $1.75. So price would have to, no, sorry, I lied. Yes. Price would have to fall $1.90 below that low. So, or below our current price. So we'd have to see a 3.8% drop in price. We'd get 3.25 if it stays where it's at. If it falls down and assigns it, we have a cost basis that is about $49.50. And then we'd have a dividend closer to 5%. So I don't mind that. It's not as high as I would normally like to get as far as implied volatility percentile, but I wouldn't mind selling the 51 and getting assigned on Bristol Myers. If it doesn't move, great. You still get paid $1.70 on the stock for 30 days. So 1 month, 3.25% return on risk, return on assignment level. So if I get assigned at 51, I've just got paid 3.25% for 30 days. If it goes up, we still get paid our 3.25%. And then we can just buy the stock before the dividend if we want to get that dividend payment. So there's still stocks in here, even on Fed day. There's still stocks they're setting up from long-term scenario that will still support us in getting paid our dividend, getting into positions that will benefit for the long term. Yeah, BMY, Merck, Lilly, all of those as far as their payments are concerned. Do you recommend set your account to where you get the dividends deposited directly into your trading account instead of your other choices leaving it in the trade? I don't like the drip system because it messes with my risk management. I would rather just have it go into the cash into the account and use it later. So it still goes into the trading accounts and you hold that. But as far as buying a fractional share, I want to trade in 100 handle blocks so I can do covered calls against it personally. And so, yeah, throw it into cash. I'll use it later. Throw it into my trading account cash and I'll use it later. I don't need it to be buying fractional shares. All right. T-minus 8 minutes until Dawn comes on. But let's talk really quickly about yeah, I won't be able to get through those. You give me 9 symbols and say, go through, look at all those. Not going to happen. Not going to happen. Now, I just told you all the bullish ones, stuff that we could get into and trade bullishly. If we're concerned and we say, hey, this is a problem, like I said, Visa, bearish. We look at stocks that are suffering today, ones that are not going to do well. We're going to see it in technology. I would say if I think that Visa is going down and I say the consumer is stretched, I think you should see opportunities to fade and go short Uber. Too late though. Kaboom, one shot. You'd also expect Dash to start suffering, and this is not too late. I like Dash all the way back down to 183. I think the companies, Uber Eats, that's why it's also, whether people still use Uber to drive places, you're going to still see a decrease in people ordering out Uber, Dash, and other things like that. I do think these are the ones that will be the first to go. If you're saying, I don't have any money, oh, I think I'm just buy Dash. And my wife says, you really hate Dash. And I say, yes, I do, because Dash adds price over. They change the prices on the websites, on the Dash order form. So they increase the price there. You have your membership cost. They increase the price there. They charge you a delivery fee. They increase the price there. And unless you're a schmuck, you're supposed to tip too. So by the time you're done, you're paying double what you would if you just went to the restaurant or store or burger place. And then if you're buying it through Klarna or the buy now, pay later type of things, Affirm, where you can actually buy your burrito now and pay for it later, you can do the wimpy trade. I'd gladly pay you Tuesday for a hamburger today. Then you have an extra cost in there. So there's four different points where you're paying more than if you just went to the store. And I think people will stop spending that money. I think they are reducing their spending, and you're seeing it with this rollover. And just like before, this is a widening pattern. I expect it minimally to go halfway through there. Today's move still gives you the opportunity to trade it back down to there. I think 183 is on the table. So 218 to 183, you have approximately what is that? $25 move, about 13 to 15% drop in Dash. Now the options on Dash, if we go over to the options, scroll all the way down, are 23%. Normally I would say that means just buy puts. If we go here and say, let's just do my version of the in-out spread. I'm going to buy 30 days out. We're going to buy the delta near 70, and then we'll wrap it up with this. Buy the delta near 70. Closest one now is 230. And how much am I paying for time decay? So I'm buying some equity because it's currently at 217. So I'm buying $13 of that as equity. Depending on where I get this to fill, about 450 is time decay. So if I'd sold the 205, I'm going to get paid that. Let's go get paid even more and sell the 210. That is $10 for a $20 spread with a positive time decay. So I end up making some time decay. If it doesn't move, I make 10 to 15%. If it goes lower, I make 100%. We used DoorDash a couple of times because they gave us a free delivery, free usage as part of, I don't use American Express. My wife has an American Express. So she say, hey, look, it's free. This is free. This is free. And so we got a free membership, and we had like $50 of credits of delivery charges. And then you could use it for the food too. So we kind of got some free food. Yeah, so they add, so if you, the way I found it on a sushi place that we've used. I pulled up just to see what the price was. Like, wait a minute, this isn't right. And the same sushi rolls that my wife always likes to get are $12. When I pulled it up on Dash, it was 17. That was almost a 50% higher cost than going directly to the store. And that's not even counting the delivery fee or a tip. All right. Don't you yell at me. I'll do what I want, Daniel. I already looked at the SPY. It's flat at fair price, like I talked about. Fair price, fair price, fair price, fair price, almost fair price, almost fair price, fair price. And you're flat for the day. The market is unsure. It doesn't know what to do. And this is where we're at. Got to pay the VIG, huh, Brandon? Yes, there's only so many times you can eat the garden in the restaurants. I used to travel a ton, and you do get to the point where it's like, I really don't even want to eat. I don't want to go anywhere. I don't want to eat here. So I totally get that. And when the company pays for it, I guess you can dash it. Yep. There are people who can continue to pay for it, but there are also people that are going to stop spending because they don't have any money. That's what we're seeing from jobs data. That's what we're seeing from the way they're spending. That's what we're seeing from Visa. So my point is, regardless if people still use Dash, Dash is pricing in slowdowns. Even if they're going to keep using it, it's still pricing in slowdowns. All right. Did we talk about 68305? I don't remember the exact number, but we certainly hit 68305. I don't remember the exact number I gave you, but we've traded across 68305 multiple times. So, oh, we were talking about the XSP trade, possibly. Yeah. All right. So I'm going to be running over into the 10% mastermind. So hang tight, 10% mastermind coming in shortly. I'm going to end this right here, and then Don will be coming back on momentarily. So there will be a slight pause and for station identification here momentarily. So Don's coming back on momentarily.